Ladies and gentlemen, let me be very direct with you, because the silver market does not reward hesitation, it punishes it. We are standing at a moment where the structure of the global financial system is tightening, pressure is building beneath the surface, and one metal, long ignored, undervalued, and manipulated, is beginning to signal something very few are prepared for. Silver is not just another commodity, it is money, it is industry, it is scarcity in motion. And when these three forces align, history does not whisper, it moves violently. What you are about to hear is not speculation. It is a breakdown of the signals, the pressure points, and the conditions that suggest one thing very clearly: silver is positioning itself for a decisive move that investors cannot afford to misunderstand. When you examine the silver market through a long-term lens, stripping away the noise of daily price action and emotional speculation, what begins to emerge is not a simple story of supply and demand, but a prolonged structural tension that has been building for decades. This is not a recent phenomenon, and it is certainly not something that started with the last cycle of inflation or the latest geopolitical disruption. It is the accumulation of years, decades, of pricing mechanisms that have not reflected physical reality, but instead reflected financial engineering, derivatives expansion, and concentrated influence over a market that is far smaller and far more fragile than most investors ever realize. For a long time, this structure held. It held because the majority of market participants did not question it. They accepted the quoted price as a reflection of truth, without understanding the difference between paper liquidity and physical availability. They did not distinguish between a contract representing silver and actual silver that must be delivered, stored, refined, and transported. And because of this disconnect, the system was able to function under a kind of quiet imbalance, an imbalance that could persist as long as confidence remained intact. But confidence is not a permanent force. It is a psychological condition, and psychological conditions change when pressure becomes too obvious to ignore. What we are beginning to observe now is not a sudden collapse, but a gradual exposure. The cracks are not appearing in one place. They are appearing across multiple layers of the system simultaneously. Inventory patterns, lease rates, backwardation events, delivery stress in key exchanges, and physical premiums in retail markets all begin to point toward the same underlying reality: the margin for suppression is narrowing. To understand this breaking point, you have to understand what suppression actually means in the context of silver. It does not require conspiracy in the simplistic sense that many people imagine. It requires structure, incentives, and scale. When large financial institutions operate in futures markets that are many multiples larger than the actual physical supply of the metal, price discovery becomes heavily influenced by paper positioning. When the majority of trading volume is not linked to immediate physical settlement, but rather to rolling contracts, hedging strategies, and speculative liquidity, then price begins to behave less like a reflection of scarcity and more like a reflection of positioning pressure. This is where the long-term distortion begins. Over time, repeated cycles of selling pressure during key market hours, concentrated short positioning during low liquidity periods, and the constant ability to create supply on paper that does not exist physically all contribute to a suppression effect. Not necessarily a fixed price ceiling, but a persistent dampening of volatility to the upside. Every time silver attempts to break away from its range, structural forces reassert themselves, not necessarily because they can control the metal indefinitely, but because they can influence timing and sentiment. However, suppression is not the same as elimination. It is more like compressing a spring. The more it is held down, the more potential energy accumulates beneath it. And in the case of silver, that energy is not just financial, it is industrial, technological, and geopolitical. Silver is not a passive asset sitting in vaults waiting for price discovery. It is actively consumed, embedded into solar panels, electronics, medical devices, defense systems, and countless industrial processes where substitution is either inefficient or impossible without significant cost. This creates a structural tension that gold does not experience in the same way. Gold is primarily monetary and ornamental, which means above-ground stocks can remain relatively stable. Silver, however, has a high rate of consumption and a low rate of recovery. Once it is used in industrial applications, a significant portion is not economically recycled. It is dispersed in such small quantities across global infrastructure that recovery becomes impractical. This means that above-ground inventories are effectively a declining reservoir, even if demand remains constant. Now consider what happens when you overlay this physical reality onto a pricing system dominated by paper instruments. You create a divergence between perceived supply and actual supply. On screens, there is always liquidity, there are always bids and offers, there is always a price. But beneath that surface, the availability of deliverable metal is far more constrained than the market structure implies. This divergence does not correct itself immediately. It builds gradually, quietly, almost invisibly to those not directly engaged with physical settlement. For years, this divergence was manageable because demand patterns did not challenge the system aggressively enough. Investors were content with paper exposure. Industrial users maintained predictable procurement channels. Recycling flows supplemented supply. But this balance is no longer as stable as it once appeared. Industrial demand is no longer marginal. It is expanding in sectors tied to long-term structural trends like electrification, renewable energy infrastructure, and digital expansion. At the same time, mine supply has not been able to respond with flexibility. Silver is often a byproduct metal, meaning its production is tied to the mining output of other metals such as copper, lead, and zinc. This creates a lag in responsiveness. Even when price signals improve, production cannot instantly scale. It requires capital investment, permitting development, and years of operational delay. So even if the market wanted to correct itself through supply expansion, the timeline does not match the urgency of consumption. This mismatch is where pressure accumulates. It is not dramatic in the early stages. It shows up as slightly higher premiums in physical markets. It shows up as tighter lease rates. It shows up as sporadic delivery stress in exchange inventories. Each signal on its own can be dismissed. Each can be explained away by temporary factors. But when they persist across cycles, across regions, and across different categories of market participants, they begin to form a pattern that cannot be ignored. And this is where the idea of a breaking point becomes relevant. A breaking point is not a single event. It is the moment when accumulated pressure exceeds the system's ability to contain it through normal mechanisms. In silver, those mechanisms include paper liquidity expansion, futures rolling, and temporary arbitrage between physical and derivative markets. But those mechanisms rely on confidence and continuity. They rely on participants believing that physical delivery will always be available at or near the quoted price. When that belief starts to weaken, even slightly, behavior changes. Buyers begin to prefer physical possession over paper exposure. Hedgers begin to demand tighter collateralization. Arbitrageurs begin to widen spreads to account for delivery uncertainty. These changes reinforce each other, creating a feedback loop where perceived scarcity becomes actual scarcity in certain segments of the market. What makes silver particularly sensitive to this dynamic is its market size. Compared to gold, equities, or even other commodities, silver's market is relatively small. That means incremental shifts in demand or sentiment can have disproportionate effects on price. A market of limited depth cannot absorb sudden changes in behavior without repricing aggressively, and when that repricing begins, it rarely moves in a controlled or gradual manner. So when we talk about the breaking point of long-term suppression becoming visible, we are not referring to a single identifiable trigger. We are referring to the convergence of structural constraints that have been building for years, now reaching a stage where they begin to reveal themselves through price behavior, inventory stress, and participant psychology. It is the moment when the gap between paper perception and physical reality becomes too wide to maintain without visible strain appearing across multiple layers of the system simultaneously, and as these layers continue to tighten, the market begins to behave in ways that suggest something fundamental is shifting beneath the surface. Something that cannot be easily reversed by the same mechanisms that previously contained it. And the implications of that shift extend far beyond what most participants are currently positioned to recognize or fully account for, especially as the velocity of these changes begins to accelerate in a way that suggests the system is moving closer to a phase where industrial demand for silver is often discussed, but rarely understood in its full structural depth. Most market participants reduce it to a simple narrative: solar panels are increasing, electronics are growing, therefore demand is rising. But that explanation is far too shallow to capture what is actually happening beneath the surface. The real story is not just rising demand, it is accelerating, non-negotiable consumption of a metal that cannot be easily substituted, cannot be easily recycled in full, and cannot be rapidly expanded in supply when pressure increases. To understand why industrial demand is quietly draining above ground supply, you first have to understand the nature of silver itself. Silver is not just a monetary metal. It is the most electrically conductive, thermally efficient, and reflective element used at industrial scale. That combination of properties makes it uniquely irreplaceable in many modern applications. Copper comes close in conductivity but falls short in efficiency. Gold is too expensive for mass industrial deployment. Aluminum lacks performance precision. This leaves silver occupying a narrow but critical role in systems where failure is not an option and efficiency cannot be compromised. Now consider how modern economies are evolving. We are moving deeper into a world defined by electrification, digital integration, and energy transition infrastructure. Every one of these macro trends increases reliance on silver at a structural level, not a cyclical one. Solar energy systems require silver paste in photovoltaic cells. Electric vehicles require silver in battery management systems, power distribution units, sensors, and charging infrastructure. Data centers rely on silver in high-performance electronics, switches, and thermal management components. Even consumer electronics, from smartphones to medical devices, depend on silver's conductivity and reliability. What is critical here is that this demand is not optional. It is embedded into the architecture of modern technology. When a solar panel is manufactured, silver is not a speculative input, it is a required material. When an EV is built, silver is not a luxury component, it is part of the functional circuitry. This means that demand is not sensitive to price in the short term in the way that investment demand is. Industrial users do not easily stop consuming silver simply because it becomes more expensive. They may optimize usage over time, but they cannot eliminate it without redesigning entire systems. This creates a fundamentally different type of demand curve compared to investment-driven commodities. Investment demand is emotional, cyclical, and reactive. Industrial demand is structural, persistent, and cumulative. Once silver is consumed in industrial processes, it is often dispersed in quantities so small that recovery is economically unfeasible. It becomes embedded in landfills, infrastructure, and electronic waste streams that are not systematically recycled at high efficiency rates. This means that each unit of silver used industrially is effectively removed from the investable above ground pool for the foreseeable future. Now expand this across decades of industrial growth. Every year, more silver is consumed into permanent or semi-permanent applications than is fully recovered back into the supply chain. Even when recycling improves, it rarely achieves full circular efficiency due to cost constraints and technological limitations. Over time, this creates a slow but consistent drain on available inventories that sit above ground in investment form, vault storage, and exchange warehouses. At the same time, global industrialization is not slowing down. In fact, it is intensifying in areas that are silver intensive. Renewable energy expansion is one of the most significant drivers. Solar photovoltaic technology alone is a major consumer of silver, even though technological improvements have reduced silver content per panel over time. Total installation volume has increased so dramatically that overall consumption continues to rise. This is a critical point that many overlook. Efficiency gains do not necessarily reduce total demand when scale expands faster than substitution. Electric vehicle adoption follows a similar pattern. While manufacturers attempt to reduce silver usage per vehicle, the sheer growth in production volume offsets those reductions. Additionally, EV infrastructure, charging stations, grid upgrades, and power management systems adds another layer of demand that is often not included in simple consumption models. These infrastructure systems require durable, high-efficiency electrical components where silver remains essential. Then there is the digital economy, which is often underestimated in commodity discussions. Every expansion in cloud computing, artificial intelligence infrastructure, telecommunications networks, and semiconductor production adds incremental silver demand. These are not one-time consumption events, they are continuous build-outs requiring ongoing maintenance, upgrades, and expansion. As global data usage increases exponentially, so does the underlying hardware footprint that depends on silver-based components. Medical technology adds yet another dimension. Silver's antimicrobial properties make it valuable in wound care, coatings, surgical instruments, and diagnostic devices. As healthcare systems modernize and expand, particularly in emerging economies, this creates additional baseline demand that is not easily reversible. What ties all of this together is not just growth in individual sectors, but synchronization of multiple growth cycles occurring at the same time. Energy transition, digital transformation, and industrial modernization are not separate events, they are overlapping global trends, and silver sits at the intersection of all three. Now contrast this with supply dynamics. Unlike metals that can be expanded quickly through dedicated mining investment, silver is often produced as a byproduct of other mining operations. This means its supply is structurally linked to the production decisions of copper, zinc, and lead miners. If those metals are not profitable or not in expansion mode, silver supply cannot independently scale to meet rising demand. This creates a structural rigidity in supply responsiveness that is rarely fully appreciated. Even primary silver mines face long development timelines. From discovery to production, the process can take many years, often over a decade. Permitting, environmental regulations, capital expenditure requirements, and geopolitical risks all contribute to delays and constraints. This means that supply cannot respond dynamically to short or even medium-term price signals in a way that would stabilize the market quickly. So when industrial demand begins to rise steadily across multiple sectors simultaneously, it does not immediately translate into visible price explosions. Instead, it first manifests in the form of inventory depletion. Above-ground stocks in exchange warehouses begin to decline. Lease rates for physical silver begin to rise as borrowing becomes more competitive. Fabricators begin to report tighter sourcing conditions. These are early warning signals that most mainstream narratives ignore because they are not reflected in headline price movements. Another important factor is the geographic distribution of demand versus supply. Industrial demand is global and decentralized, while significant portions of refined supply are concentrated in specific regions. This creates logistical friction in times of stress. Even if total global supply appears sufficient on paper, the ability to deliver physical metal to where it is needed becomes increasingly constrained when transportation, refining capacity, and regional demand spikes are factored in. As these pressures build, a subtle but important shift begins to occur in market behavior. Industrial users, who are typically price-sensitive but operationally constrained, begin to prioritize security of supply over cost optimization. This means they may lock in long-term contracts, build buffer inventories, or accept higher premiums to ensure continuity of operations. These actions further reduce available liquidity in the open market, tightening conditions even more. Meanwhile, investment demand begins to respond to the same signals, but in a different way. Investors often react to rising industrial demand narratives by increasing exposure, not because they require the metal for production, but because they recognize the implications of tightening supply. This introduces a second layer of demand on top of the already structurally rising industrial base. What emerges is a compounding effect. Industrial demand removes silver permanently from circulation. Investment demand competes for remaining liquidity. Supply remains rigid in the short term and only slowly responsive in the long term. Each cycle reduces available buffer stock further, meaning that the system becomes progressively more sensitive to shocks. This sensitivity is critical. In a market with abundant surplus, shocks are absorbed easily. In a market with thin inventories, even small disruptions can create disproportionate price responses. A delay in shipment, a temporary production outage, or a sudden demand spike in one region can ripple through the entire pricing structure because there is no meaningful cushion left to absorb variability. So when we say industrial demand is quietly draining above ground supply, we are describing a slow, persistent extraction process occurring beneath the surface of price charts. It is not dramatic in the moment, but it is relentless in aggregate. Each year, slightly more silver is consumed than is easily returned. Each expansion cycle in technology adds new demand that does not fully retreat in downturns. Each efficiency improvement is overwhelmed by scale expansion. Over time, this creates a condition where the visible stock of silver available for free trading becomes increasingly tight relative to the scale of industrial usage embedded in the global economy, and that divergence continues to widen in a way that suggests the pressure building beneath the surface is not only sustained but gradually intensifying in a manner that the current pricing structure has not yet fully accounted for.